Alright, let's get right into it. 10 best Vanguard funds for ultimate wealth building. And hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. Number 1 on our list is my personal favorite and the king of all index funds, the Vanguard Total Stock Market Index Fund, VTSAX. An ETF equivalent is Vanguard Total Stock Market ETF, VTI. VTSAX has an expense ratio of 0.04% and minimum investment requirement of $3,000. In the past 10 years, VTSAX had an amazing return of 12% annually. If you had put $10,000 10 years ago into VTSAX, it would have grown to close to $32,000 today. With assets under management of $1.4 trillion, it is the most popular and biggest index fund in the market. The fund aims to track the CRSP US Total Market Index, Center for Research and Security Prices, probably the most comprehensive total market index that includes every publicly traded company in the US, approximately 4,000 at the time of this video. And the fund is by design self-cleansing, automatically replacing dead and dying companies from its fund with new and upcoming companies with great potential. When you invest in a fund like VTSAX, you're believing that the US economy will continue to grow and US companies will continue to create value to its customers. If you love simplicity like I do, you essentially can invest all your money in this one fund, and that will be your investing strategy. Yes, a one fund strategy. It's not sophisticated, it won't make much for dinner conversation, but it gets the job done, and that is what most often matters. Number 2 on our list, Vanguard Total Bond Market Index Fund, VBTLX. An ETF equivalent is Vanguard Total Bond Market ETF, BND. VBTLX has an expense ratio of 0.05% and minimum investment requirement of $3,000. With assets under management of $300 billion, it is the most popular bond index fund in the market. The fund aims to track the Bloomberg US Aggregate Float Adjusted Index, providing investors investment exposure to US investment-grade bonds, including US Treasuries, mortgage-backed securities, and quality corporate bonds. At the time of this video, it represents approximately 10,000 different individual bonds. Bonds are an essential part of any well-diversified portfolio, especially as you get closer to retirement age. At a high level, a good way to think about bonds in comparison to stocks is to consider them as an investment that will smooth out our volatile stock investment ride. Stocks are a great wealth-building tool for the long run. However, in the short run, they can be quite volatile, moving up and down constantly at the whim of slightest threatening news. Bonds, on the other hand, might not have the big long-term returns, but it doesn't have all that volatility that comes with stocks. If you were to compare the total stock market trend, VTSAX, versus total bond market index, VBTLX, in the past 20 years, VBTLX has smaller overall gains, 1.5% in returns versus VTSAX's 12%, but it has much less volatility than VTSAX. What having bonds in your portfolio will do for you is that during times of market crash, where your stock investment can dip by 20 to 30%, your bond investment will hold your portfolio steady. And in my personal opinion, Vanguard Total Bond Market Index Fund, VBTLX, is one of the best bond funds to have in your portfolio to help smooth out your investment ride. Alright, so at this point, if you want to have a good enough solution to your investment portfolio, you can essentially stop right here. Actually, I would dare to say this is a great solution. A very simple 2-fund portfolio. VTSAX for growth and VBTLX to smooth out the ride. But let's say you want to add a bit more diversity to your portfolio. In that case, let's review some other options. Number 3 on our list is Vanguard Total International Stock Index Fund, VTIAX. An ETF equivalent is Vanguard Total International Stock ETF, VXUS. VTIAX has an expense ratio of 0.11% and minimum investment requirement of $3,000. In the past 10 years, VTIAX had an average annual return of 4.7%. This means if you had put in $10,000 10 years ago into VTIAX, it would have grown to close to $16,000 today. You might be thinking, with returns less than 5%, why would I even consider an international fund like VTIAX? Let me explain. VTIAX, with assets under management close to $400 billion, is the most popular international index fund in the market. The fund aims to track the FTSE Global All Cap excluding the United States index. The index is made up of large, mid, and small cap stocks globally excluding the US, essentially 98% of the world's investable market capitalization. At the time of this video, this fund represents approximately 8,000 international companies from both developed and emerging markets: England, Japan, China, Portugal, Philippines, and Brazil. And big companies like Taiwan Semiconductor Manufacturing, Nestle, Tencent Holding, ASML Holding, and Samsung Electronics. We're only investing in US-based companies by holding only US-based stocks. We're potentially missing out on the portfolio growth that these international companies can provide. US stocks provide great return on our investments, but US stocks still represent only about half the world's stocks. The total stock market value of the world is approximately $94 trillion, and the US companies represent $45 trillion of that, or about 48%. Though the last 10 years wasn't a great time period for international market, there have been times in history when international companies outperformed US companies. So if you want to add a bit more flavor to your 2-fund portfolio, VTIAX would be a great addition to make it the very popular 3-fund portfolio. Real quick, there are a lot of funds I'm covering in this video, and it's hard to keep track of all of them. So in order to make the process of learning about these funds easier, I created a free PDF downloadable that lists all the funds I'm covering in this video with respective details. It includes the respective expense ratios, index that they're following, and the approximate number of securities in each fund. If you'd like a free copy of this PDF, go to the link I'll have in the description below. Alright, with that said, let's get back to the video. Number 4 on our list is the Vanguard 500 Index Fund, VFIAX. An ETF equivalent is Vanguard S&P 500 ETF, VOO. VFIAX had an expense ratio of 0.04% and minimum investment requirement of $3,000. In the past 10 years, VFIAX had an average annual return of close to 13%. This means if you had put in $10,000 10 years ago into VFIAX, it would have grown to close to $33,000 today. Slightly better than VTSAX, which had an average annual return of 12%. Let's see why this may be. The Vanguard 500 Index Fund VFIAX mirrors the S&P 500 Index, offering exposure to 500 of the largest companies in the US stock market. If you remember earlier when we were talking about VTSAX, VTSAX represents all 4,000 publicly traded companies in the United States. VFIAX, on the other hand, only represents 500 biggest companies, excluding approximately 3,500 smaller companies. And for a long time, the S&P 500 was, and in a way still is, the most widely used representation of the stock market. In the news, when people are most often talking about the stock market, they're most often referring to the Standard & Poor's 500, not the total market index. And that is because the 500 largest companies are what really moves the market. Companies in the index are not represented equally. Rather, they're represented by the value of their market capitalization. Bigger the company, bigger the representation. Thus, Apple, with a market cap of $2.7 trillion, represents around 7% of the S&P 500. And when these big companies are doing really well, VFIAX in turn performs well, which has been the case for the past 10 years. Therefore, if you like the idea of holding primarily the biggest companies in your portfolio, VFIAX is a great replacement to VTSAX as your core equities holding. But understand that VTSAX and VFIAX are very similar to each other. So I personally don't think it really matters which one you pick. Just pick one and invest as much of your money into it as possible. Number 5 on our list is the Vanguard Total World Stock Index Fund, VTWAX. An ETF equivalent is Vanguard Total World Stock ETF, VT. VTWAX has an expense ratio of 0.1% and minimum investment requirement of $3,000. The fund is pretty new, so we don't have exact data going back to 10 years, but if it had existed 10 years ago, VTWAX would have had an average annual return of close to 9%. This means if you had put in $10,000 10 years ago into VTWAX, it would have grown to $23,000 today. Now, why would anyone even consider VTWAX? Let's take a look. The Vanguard Total World Stock Index Fund represents close to 10,000 stocks from all over the world, including the US, developed foreign markets, and emerging markets. It holds big US companies like Apple, Microsoft, and Amazon, as well as big international companies like Taiwan Semiconductor Manufacturing, ASML Holdings, and Samsung Electronics, all in one fund. The split is approximately 60% US and 40% from the rest of the world. It essentially is the one-stop fund that represents the global stock market. This fund will be ideal if you like exposure to both the US and international equities market, but you don't want to hold two separate funds, VTSAX and VTIAX. This one fund would do all the work for you. Now, personally, I like to control how much international exposure I have, so I like to keep things separate. But this is a personal preference. And 0.1% expense ratio isn't that appealing given I can buy VTSAX at 0.4% and even cheaper at 0.3% if I was to go with the ETF version, VTI. But what do I know, right? I'm just some random guy on YouTube. If you want to simplify your domestic versus international exposure, VTWAX could be a good option to look at. Number 6 on our list is the Vanguard Real Estate Index Fund, VGSLX. An ETF equivalent is Vanguard Real Estate ETF, VNQ. VGSLX has an expense ratio of 0.12% and minimum investment requirement of $3,000. In the past 10 years, VGSLX had an average annual return of close to 7%. This means if you had put in $10,000 10 years ago into VGSLX, it would have grown to $19,000 today. The Vanguard Real Estate Index Fund is a REIT, Real Estate Investment Trust, a company that owns, operates, and finances income-generating real estate. They're essentially a mutual fund that holds real estate. Just as mutual funds allow us to buy publicly traded companies without buying individual stocks, REITs allow us to tap into the real estate market without having to actually buy, manage, and finance any properties ourselves. VGSLX represents approximately 160 real estate companies that represent all types of property investments, office buildings, hotels, and even residential homes. It isn't necessary, but if you want to add some real estate flavor to your investment portfolio, this REIT fund, VGSLX, could be a good addition. There have been times in history when REITs perform better than stocks. So this fund may offer some diversification to a standard 2 or 3 fund portfolio. Personally, I wouldn't make this a core holding, but it never hurts to have additional flavoring as long as you're not overcomplicating your dish too much. Number 7 on our list is the Vanguard Small Cap Index Fund, VSMAX. An ETF equivalent is Vanguard Small Cap ETF, VB. VSMAX has an expense ratio of 0.05% and a minimum investment requirement of $3,000. It represents approximately 1,400 what finance people call small cap companies. In the past 10 years, VSMAX had an average annual return of slightly over 9%. This means if you had put $10,000 10 years ago into VSMAX, it would have grown to over $24,000 today. Now, how would a VSMAX fit into our portfolio? Let's take a look. In the finance world, companies get categorized based on the size of their market value. Large cap, mid cap, and small cap. Large cap companies are companies valued more than $10 billion. Think of big boys like Apple, Amazon, and Microsoft. Pretty much all the companies represented in the S&P 500. Mid cap companies are companies with market capitalization generally between $2 billion and $10 billion. Some companies classified as mid cap include PG&E, Kroger, and Dollar Tree. And small cap companies are companies generally valued between $300 million and $2 billion. You probably have not heard of many of these companies unless you've been following them for a specific reason. And at times, different sized companies operate differently, therefore likely affect their future performance. A big company might not have the aggressive growth trajectory like a small up-and-coming startup. And investors often look to mid-cap stocks as being more stable than small-cap, while providing stronger growth opportunities compared to large-cap companies. And small-cap companies, though may experience more volatility and pose high-risk investors, have the potential for higher rates of growth. Though this is hard to predict given many of the large companies these days are tech companies, and they move at their own pace regardless of their size. Nonetheless, if you believe that small cap companies have potential to provide greater returns in the future, VSMAX will serve that purpose and could be a nice addition to your portfolio. Number 8 on our list is the Vanguard Mid Cap Index Fund, VIMAX. An ETF equivalent is Vanguard Mid Cap ETF, VO. VIMAX has an expense ratio of 0.05% and a minimum investment requirement of $3,000. Vanguard Mid-Cap Index Fund, as its name states, is a fund that represents mid-cap companies. At the time of this video, this fund holds around 340 mid-cap companies. In the past 10 years, VIMAX had an average annual return of slightly over 10%. This means if you had put in $10,000 10 years ago into VIMAX, it would have grown to over $26,000 today. And the reason to add VIMAX to your portfolio will be identical to adding a small cap fund. When we look at history, there have been times when small cap and mid cap companies have done a bit better than large cap companies. And though there are thousands of small and mid cap companies already represented in a total market index fund like VTSAX, they hold a minor position because of market capitalization. If you want to gain greater exposure to the mid cap companies or small cap companies, or both, you can by adding VSMAX and VIMAX to your portfolio. Number 9 on our list is the Vanguard Total International Bond Index Fund, VTABX. An ETF equivalent is Vanguard Total International Bond ETF, BNDX. VTABX has an expense ratio of 0.11% and a minimum investment requirement of $3,000. This fund is designed to provide broad exposure to non-US investment-grade bonds. The fund seeks to track the performance of an index that includes international government, agency, and corporate securities, mostly from developed countries, but also some emerging countries as well. VTABX represents close to 7,000 bonds from government agency, and corporations, all from approximately 40 non-US countries, all issued in currencies other than US dollars. Think Australian government bond, African Development Bank, or the Bank of Nova Scotia. Now, if you're already holding VBTLX, that is great. And as you get closer to retirement age, VBTLX should help stabilize your portfolio. However, if you want additional exposure to the bond market, this fund can do that for you. Some exposure to the international bond market can help buffer our portfolio against US-specific risks. For example, there have been times in history where inflation ran higher in the US than other parts of the world. Of course, this can work the other way as well. A few things to note regarding VTABX versus VBTLX. Though the average annual return over the past 10 years for VTABX at 2% is higher, VBTLX 10-year return was 1.5%. Understand that the international bond market is a bit more volatile than the US bond market. Number 10 on our list, Last but not the least, the Vanguard Target Retirement Funds. Does everything that we talked about so far just make your head spin? Do you have absolutely no desire to learn any more about investing than you need to? Well, then this fund might be exactly what you need. In a nutshell, Target Retirement Funds are simple funds that automatically diversify and allocate your investments for you, all based on when you plan to retire. Diversify and allocate across domestic stocks, bonds, and international market. Many people who enjoy learning about the stock market and investments like to manage their own risk by constructing their own portfolio. But if you're looking for a simple 85 to 90% solution to your investment, Vanguard Target Retirement Fund are a great option. When you go to Vanguard's Target Retirement Fund website, you'll find several different funds there. You just need to select the one based on your estimated retirement year. Let's say age 65. For me, that would be Vanguard Target Retirement Fund 2045, VTIAX. The expense ratio on this fund is 0.08%. Interestingly, actually cheaper than some of the individual funds we covered so far. And it already includes many of the funds that we discussed. Vanguard Total Stock Market Index Fund, Vanguard Total International Stock Index Fund, Vanguard Total Bond Market Index Fund, and even a bit of Vanguard Total International Bond Index Fund. And what this fund of funds will do is reallocate these funds from aggressive to more conservative as you get closer to retirement age. If you want to make good investment decisions, but want to spend the least amount of time as possible on it, it doesn't get any easier than Vanguard's Target Retirement Fund. You can literally set it up once in your life and check it when you're ready to retire. Thank you guys for watching. In the spirit of simplifying our lives, if you want to simplify your money, please check out my video here. Until next time, all the best.